Hey everyone, welcome back. If you're buying or selling a home in today's real estate market, you've probably heard about interest rate buydowns because low interest rates are a thing of the past and they have made home buying pretty expensive. We've had interest rates all the way up to 8% in the last couple of years. Right now, they're hovering around 6. But what's the best option? A 2-1 buydown or a full buydown? Let's compare and discuss. So understanding the difference, first of all, can make or break your home sale. And today I wanted to get into the details a little bit so that you can make the right choice. It can be tricky when there is a lot of financial information and numbers. I know that's not always my favorite, but let's dive in and discuss. And I think by the end of this video, you'll be able to have some clear ideas about what situation would be best for your particular purchase. So first, let's define what a rate buydown actually is. In real estate, a buydown is when the seller, the builder, or the lender helps lower the buyer's mortgage interest rate, which will sometimes be for a certain period of time, by covering some of the upfront interest cost when the buyer is applying for the new loan. So this makes homeownership more accessible and affordable initially. And the assumption is that the rate may go down later, or the buyer's financial circumstances will improve because maybe they just started a job or they're younger in their career. And this works especially well in a very high interest rate market like we've been in. So let's talk about two main buydown types. We've got the 2-1 buydown and the full buydown. The 2-1 buydown is only a temporary rate reduction, and it works like this. So in year one, the interest rate is reduced by a full 2%, which could be huge. So at a 6% interest rate, you're looking at 4%. At a 7% interest rate, you're looking at 5%. In year two, and by the way, that can make up to hundreds of dollars of difference on your monthly payment. So in year two, it's reduced by only 1%. It goes up the next year. And then in year three, it returns to the original loan rate or the current loan rate of the interest rate market at that time. So for example, if today's market rate is 7, the buyer, as we already said, pays 5% in year one, 6% in year two, and then back to 7% in year three, or can have the opportunity to refinance in year three if the rate in fact has gone down by then. So this strategy makes the home much more affordable up front. And in those highest interest paying years where you're paying usually more interest than you are on the primary for the loan, this strategy can make a lot of sense and can ease the buyers into the full mortgage payment later with a higher rate if the rate stays stuck, which it usually doesn't stay stuck as high as it's been. So it's an excellent tool for sellers to try to attract buyers who might be hesitant about higher rates. And it's a great tool for buyers to get into what they need to get into and will be able to afford better later or have better rates later. Okay, let's compare the 2-1 buydown with a full buydown, which is also called a permanent rate buydown sometimes. Here, the seller or the builder pays points up front to lower the buyer's interest rate for the entire life of the loan. And this can be more expensive, which is maybe why it's not used quite as often, but it's not just for 2 years. And for instance, instead of a buyer locking in at 7% or 6.5%, the seller might contribute in the tens of thousands of dollars range. Like I said, it can be expensive, but it would be enough sometimes at $20,000 to bring that interest rate down a full point to a 6 or even a 5.75 rate permanently. So while this costs more upfront for the seller, it is a great incentive for buyers because they just wouldn't be able to get this rate otherwise in the current interest rate market that we're in. So this can offer stability, lower payments for the long term, less likelihood of the buyer needing to refinance within the next 2 to 3 years. So which one is better? It just depends on your situation. Especially, hey, maybe you're planning on moving in 3 years. You're only keeping the house for a couple of years and you just need to break even. So let's compare the pros and cons again. 2-1 buydown, lower initial payment. You can get quite a bit lower for less money. And this can attract hesitant buyers, and it can be great for buyers that are expecting to refinance later, and more cost effective for sellers too. Now, the 2-1 buy down cons are payments increase after year 2, and buyers will need a solid plan in place for those higher future payments that they might be facing. Okay, full buy down pros. It locks in a lower rate permanently. It will allow the buyer to have an attractive option for a really competitive interest rate in a market that has high interest rates. And it reduces the monthly payment for the buyer over the course of the entire life of the loan. And it can reduce it significantly. I mean, 1 point on an interest rate can make a really big difference. Like I said, a couple $100s of difference a month for a buyer. The cons are that it's much more expensive to make this happen. The buyer can contribute to this too. It doesn't just have to be the seller. And so you want to compare if the buyer is paying for it. Will it cost them more in interest over the life of the loan, or will the buy down cost more? Your lender can run those numbers for you. And it might not even be necessary if the rates do end up dropping and the buyer plans to refinance when the rates drop anyways. So the permanent buy down cost may not be worth it. So as a seller, should you offer a 2-1 or full buy down? It just depends on the buyer. But if you want to attract more buyers without spending so much money, the 2-1 buy down is a really attractive option and a great way to get people interested in your property. And if you want to offer something more permanent, I would say if you're targeting, long-term buyers, you could offer a full buy down, run the numbers with a lender. Even if you're a seller, you could vet the numbers with a lender and see if it's worth offering that incentive for buyers. The full buy down might seal the deal more solidly for some buyers, kind of depends on their plans and personality. But I would say the 2-1 buy down is a really competitive way to get people interested. And buyers, if you're planning on refinancing anytime in the next few years, or maybe moving on to another property and the property you're looking at is like a starter or interim property, the 2-1 buy down makes a lot of sense. And it would just be smart to consider it as a really solid option, because it can save you a lot of money up front that you won't necessarily have to make up somewhere else later. So at the end of the day, it matters to your situation, which is what a lot of my advice always says, is we need to look at your situation. And both options do help make homeownership more affordable, and sellers who understand both of these options and strategies will have a much better opportunity to connect with buyers and have an advantage in today's market to get buyers in the door. Buyers who understand this have an opportunity to save some money and add something to their negotiations when they're trying to purchase a property. So if you found this video helpful, hit like button, subscribe, let me know in the comments, and let me know if you have questions or opinions on these buy down options. And maybe tell me, are you considering offering a buy down? Here at West End neighborhood, the builder is offering a buy down. So if you like the house I'm sitting in, you might want to consider taking a look, because this builder is offering a really good 2-1 buy down. I'd love to hear your thoughts. You can get into this house or other houses in the neighborhood with that 2-1 buy down, and your payment was almost $900 a month lower with the 2-1 buy down. So let me know what you think, and let me know if you have any questions. I can help you get into the right place at the right price. Thanks for watching, and I'll talk to you soon.